Recently, the S&P 500, Nasdaq 100, and Dow Jones indices have continued to reach new highs before showing signs of slowing down. This has led to concerns among those considering investing in U.S. stocks, worrying about entering the market at a peak. Many people are questioning whether now is a good time to start investing in U.S. stocks. In today's video, we will explore whether U.S. stocks are really at a peak from 3 perspectives and 6 reasons. First, we'll examine 3 reasons why some believe U.S. stocks are at a peak. The first reason is the significant stock price increases from last year to this year, with the U.S. stock market rallying by about 32%, which has been a cause for concern. The second reason is the recent rally, especially in a handful of AI-related companies like Nvidia, reminding some of the dot-com bubble's focus on IT companies, suggesting a potential bubble in the market. The third reason is that Warren Buffett's Berkshire Hathaway is holding a record $167.6 billion in cash, often seen as a sign that the stock market may be at a peak if such a seasoned investor is stockpiling cash. However, my view on these reasons differs, and we'll explore this alongside 6 other reasons. One major point of discussion is whether the recent highs or peaks in stock prices signal a bubble that could lead to a downturn. We will discuss this without considering earnings for now, focusing instead on the performance data of the S&P 500, as many of our subscribers invest in it. An article by Invesco about peak renewals suggests that the stock market does not average down, indicating that the long-term upward trend of the S&P 500 is not unusual. Furthermore, the price itself is not as important as the long-term earnings growth of U.S. companies, supporting sustained stock price increases. Remarkably, the S&P 500 has reached new highs 1,176 times since its inception in 1957, almost once every 2 weeks. If we maintain confidence in the continued upward trend of U.S. stocks, these new highs should be seen as natural. It's also noted that significant market bubbles, such as the 1929 Great Depression, the 2000 dot-com bubble, the 2008 financial crisis, and the 2020 COVID-19 crash, were preceded by dramatic stock price increases not observed in the recent 3-year performance, suggesting the current market may not be in a bubble. Another point of interest is the focus on a few AI companies, like Nvidia, which has been a source of unease. However, stock prices ultimately follow earnings, and it's crucial to consider earnings alongside stock prices. Nvidia's P/E ratio, for example, is expected to drop significantly this year, potentially making its stock price more reasonable compared to its earnings. Lastly, Berkshire Hathaway's record cash holdings have been discussed, with the consideration that while cash holdings have increased, so have earnings, indicating not just caution but also an accumulation of assets. When looking at Berkshire Hathaway's cash holdings relative to its total assets, the current levels are within historical averages, suggesting that a high cash reserve level does not necessarily predict a market downturn. In conclusion, while concerns about investing at market peaks are understandable, the current U.S. stock market conditions, backed by strong earnings and historical patterns, do not necessarily indicate a bubble. The suggestion for investors is to maintain a level of cash reserves that aligns with their comfort for uncertainty and to consider consistent, gradual investments as a strategy for long-term growth. Thank you for watching, and I hope this discussion supports your investment journey.